Hi there, hope you're doing great today. Is real estate investing right for you? That's a question we receive often, and in today's quick video, we'll attempt to provide a few pluses as well as a few minuses and a few key points that you can take into consideration as you are looking to make that decision, namely, is real estate investing right for you? As usual, our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. We'll start with the pluses first. Real estate is a great source for additional cash flow and providing additional income stream. And not only that, but when you buy a property, typically lease it to tenants, those leases are set on an annual basis. So you have the ability to reset the rent according to the latest and greatest market trends. So one source of return is the cash flow generated from owning the property. Another source of return for real estate is appreciation. Admittedly, when you purchase a property, especially in the commercial space, where properties are valued based on the income that they generate, you have the ability to improve the profitability over time and thereby increase the value. So appreciation is number 2. Number 3 is diversification. Many people usually start by investing in stocks, bonds, basically the equity market. And that's not a bad way to get started, especially if you have an employer-sponsored retirement plan. That may be even your only option: stocks, bonds, and mutual funds. But over time, as you grow and look to diversify your own portfolio, real estate is a great asset class to look into for a number of reasons, including long-term track record and returns generated over time, which we've written a couple of articles on. Number 4 is the tax deferral benefits, and that's something very powerful. The government provides incentives to individuals and companies to provide housing, and many, when doing so, they also employ people in the local markets. And so to provide, one of the incentives that the government provides with in that respect is the ability to defer taxes by virtue of one big non-cash expense known as depreciation. And that tax deferral is powerful because it carries the benefit of time value of money. Number 5 is using leverage. Some people call it other people's money, but real estate is a hard asset, tangible asset. So very often banks would lend against it when the market sponsor and deal parameters are right. In order to purchase a property, one does not need to provide 100% of the cash proceeds. Often a lender would put in as much as 60 or 70% of the purchase price, thereby enabling people to make that investment. And number 6 is a hedge against inflation. Real estate in the long run continues to appreciate and increase in value. Of course, it goes through up and down cycles, so it's not a straight line up, but in the long run, if you're patient enough and if you hold long enough, you will be rewarded for your patience. With that said, what are some drawbacks and why you may want to pause and perhaps not consider investing in real estate? Number 1, it's an illiquid investment. Unlike stocks and bonds that you can easily buy and sell in the open market, you cannot do that with real estate. Yes, you can sell the property, but typically that could take anywhere from 60 to 90 days. It's not something you can liquidate on a whim. So being prepared for that and having the funds tied up for that extended period of time. Number 2, in order to purchase a property requires a substantial amount of starting capital. Now, you can work with a lender that could bring 60 or 70, in some cases maybe even 80% of that purchase price, but you still need to have sufficient liquidity not only for the remaining 20-30% of the down payment, but also for operating reserves. So having that starting capital may delay the timing of when you start investing, either by yourself or with partners. Number three is location. Location is key. Real estate is not national, not even regional. It's very local, hyper local. Even within the same city, properties within different neighborhoods will carry different valuations, appreciation potential, and so forth. So being able to knowing your market really well is key. And sometimes you may be even looking to invest out of state simply because investing opportunities in your backyard are limited. So it's imperative to do that diligence upfront when you don't have the investment in your backyard. Number four is having a long-term horizon. As we stated, yes, in the long term, real estate appreciates in value, but it is definitely a slow and steady journey. Time can actually cure a lot of mistakes in real estate as well, as long as you have ability to be patient if you're going through those rough waters, or conversely, not looking for quick riches because that definitely does not happen in real estate. So having that longer term horizon and patience is key. Number five is the risk of over leverage. Yes, you can utilize as what we just called other people's money, but it's extremely dangerous to over leverage yourself, meaning taking on too much debt, because especially if you go through a down cycle, and we're going through one right now, if you're say 80% levered and your property declines by 30% in value, you're already underwater, and the property may not even be worth the loan amount. So it's important in those situations to have those rainy day funds and either pay down the loan or deploy that excess liquidity to stabilize the property in those moments of distress. And last but not least, which we actually touched on just now, it's owning real estate is almost like running a business, whether it's a single family home or apartment. Apartments are of course a lot more complex, but each property is its own individual business. So having a good grasp of the numbers, understanding the profit and loss statement, the balance sheet, we just talked about liquidity and reserves, is key, and certainly not for the faint of heart. So we hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.